Good evening, partners. Warm welcome. Almost we have more than 100 partners already joined. I think we are getting some request on my WhatsApp. Siddharth, just one minute. I think there's some technical error. People are not able to join. I'll just check my settings once before we go live. Oh, I think I have disabled the chat. Yes, now it's active. Yeah. Good evening, partners. Welcome once again. Okay, thanks for taking out this time on this Diwali weekend, sharing time to learn new things. Today we have with us Mr. Siddhartha Dash. Okay, he is the Senior Vice President in UTI Mutual Fund. He has got more than 2.5 decades of experience in the industry, and it's really a pleasure to have Siddharth with us. Okay, and today we are here to discuss on a very unique topic. Your behavior determines your wealth. Okay, Siddharth, first of all, warm welcome. First question, before even we go into the topic, market क्या लगता है?
Thank you very much, Kapil, and thank you everyone for joining in.
You are resounding. Can you just check your audio settings?
My audio, is it fine now?
It's resounding.
I just unmuted. Is it fine now?
No, it's again getting a resound. Just
I have not joined in any other thing.
can you just disable and enable again the audio?
How's it now?
We are getting a little bit of resound. Little.
So shall I rejoin?
Just check the audio settings once. Go to audio settings, set the microphone. In the mic, near the on the ground, you'll have audio settings.
Yeah, my audio settings look fine. It was. How's it now? Is it better?
Yeah, it's resounding again. Previously, it was very fine. Suddenly, it's resounding.
Yeah, it was okay. It was all good. So let me just do one thing. Let me just give me a few seconds. Let me just log off and log in again.
Yeah. Thank you, guys. People are already giving us tips how to reduce the echo sound. Thank you, guys. Acha, before Siddharth joins back, there is a lot of requests I'm getting. Shall I take one more session on ChatGPT? Please give a chat. Yes. Put a chat. Yes on chat. Do you want one more session on ChatGPT? If you want, just put a yes in the chat box. Not in Q&A, chat box, yes. Type yes. I'll just put you for understanding. Type yes. If you can see me.
Kapil, you need to tell me whether the echo is still there.
No, it's completely clear now.
Wonderful. So now you need to make me the co-host as well so that I can switch on video.
Once I can. Yeah, done.
Good. So I think we are good to go. So apologies for a little bit of a technical glitch, but thank you, Kapil, and thank you everyone for joining in. And before I go to the first query, let me put it that way. It's not a question, query that Kapil has put me. I hope everybody is not surprised to see a little two different faces, one without a beard and one without a mush, from the invite that was sent. So we are the same people. Kapil is minus his beard and I'm minus my mush. So that's the clarifications, and once that's out of the way, so markets kaisi lag rahi hai is a very relevant question, but it is also very it's a question probably through today's presentation we'll try and address, because market jaise bhi lag rahi ho, what is important is to ensure that we are staying true to our course, our clients are staying true to their course, and they ensure that their behavior, their investment behavior is something which is which is tuned towards generating wealth. So whether the market जैसे भी जा रही हो, जिस तरह भी लग रही हो, what is important is that we need to stay true to investment behavior. So that's the topic for today, and I think this query probably by the end of the session would be answered to some extent.
Okay. Uh, Siddharth, when we are discussing about this topic, your behavior will determine your wealth. Most of the partners had this query. Is this not client centric, where we are going to address this topic to the clients? Why are you inviting partners for this session? Okay, what was one of the main query which all partners said, sir, ये client का meeting है ना, sir, this kind is for meet for clients or for partners? Sir, are you sure is this for partners? These were the kind
Yeah,
of queries I was raising. So would
yeah.
you not like to put some light on that?
Yeah, sure. So, I've been in sales for about 25 years plus now. And, the most important thing about sales is to understand customer behavior. If you have to do a good sales, you have to ensure that your product is selling well. It is very important that, customer behavior is understood. Big companies have spent billions of dollars to understand customer behavior. Why? Because then they can decide which product to sell. One, they can also try to work towards managing customer behavior, because managing customer behavior will also determine the degree of success of sales. And that is what every good salesperson has to understand, because it's not just about pushing a product, it's about understanding the customer psyche and giving them the proper advice. In mutual fund industry, which is an investment industry, I think it is equally more important, because when we are making a sales pitch, it's not a pitch to sell a product and that product is done for the day. You are through for the day. It's a very very long term relationship that we are all getting into, right? And investing is definitely a long term relationship, and when you're looking at a long term relationship, it is extremely important to understand the psychology of the customer, and that is what the salesperson has to be very very good at. Because unless you do that, there will be some hitches which will come in your way, and that will impact your business. And therefore, understanding customer behavior is equally important. So this topic about your behavior determines your wealth is for the customer, of course, to make his wealth, but for the distributor fraternity to ensure that the customer stays with you and adds on to your AUM in the years to come.
Great, understood. So, if all the partners who are attending this session, more than 150 people are attending already. So, if they like this presentation and if they want to do it for their clients, can we repeat these sessions for the clients?
Anytime, my team will be very happy to repeat these sessions for the clients, because end of the day, it is about ensuring that all the clients have the right perspective about investing. Because unless and until you have the right perspective, the trust will not be built up, the confidence will not be built up. So we'll be more than happy to keep on repeating the sessions as and when is required.
Okay. Now, completely over to you, Siddharth.
Thank you so much. Thank you so much. And once again, a very warm welcome to everyone for this session. I'll just share the slide, and Kapil, you'll have to just confirm whether the presentation is visible
Visible?
and is it on full screen mode.
Not yet. Yes, it's not on full screen.
Great. So thank you very much. So thank you, friends. And as Kapil mentioned, the topic of today's presentation is your behavior determines your wealth. Now, as I mentioned earlier, it is the behavior of the investing client, as well as how do we, as distributors, as advisors, manage their behavior so that it increases their wealth, builds confidence, builds trust with us, and therefore builds our business model as well. This is a study which was done in the US, and recently Morningstar conducted the study in India as well. There is something called the investment return and the investor return. And this is a classic example where you will see that the investment return, which is the returns that you generate from investing in a particular class, is let's say X percentage. However, you will generally see that the investors who have invested in that asset class would be X minus. So the blue bars in the left side is the investment return. The blue bar is actually the investor, what he or she gets, which is lesser than what the investment return in that asset class is. And the difference that you see in the orange bar is what is called as the behavior gap, which is the investor's behavior, which determines this return, suboptimal return that he or she is getting. And that is what we call as the behavioral gap. Now, why do we have these behavior gaps? Let's go a little bit ahead. So this is a very cliched slide. I think all of the partners would have seen this, but I think it makes sense to see this slide again and again and again, because this slide reinforces our belief, our commitment to this industry, to the Indian economic markets, to the long growth story that India is poised to have. Now, if you look at it, this is the pure Sensex returns for the last 45 years. Now, you may come back and say that, over the last in the 45 years, if you break it down into different decades, obviously returns in some decades will be much higher as compared to returns in some other decades. But net, if you look at the returns from April 79 to March 2024, the markets have given a 15.25 CAGR return in the last 45 years. I do not think any other asset class can match a 15.25% CAGR over a 45-year period. Now, in this 45-year period, you have had a host of volatilities in the market, host of incidents in the market, the balance of payments crisis. We had the Harshad Mehta scam. We had lots of political uncertainty. In fact, at UTI, if I may, I think we have been one of the organizations which have gone through the Harshad Mehta scam in a very, we were affected really badly during that period. The uncertainties, the dot-com bubble, the market sell-off, the global financial crisis in 2008, the Eurozone debt crisis, of course, the coronavirus crisis. So these are some of the headline crises that the markets have seen, in spite of which the markets have given 15.25 CAGR in 45 years. So this is a slide which sort of reinforces our commitment, our belief in the capital markets that India has, the economy that India has, which has shown a phenomenal growth. And we continue to believe in this growth story of the Indian economy. Let me give you another perspective. Now, we saw that the economy has grown by about 15.5%, right? 15.25% over the last 45 years. Now, let me give you examples of three particular, parameters of the economy. So we've seen over the last 20 years, this is a period from 2003 to 2023. Now, in the extreme right side, you will see the Nifty 50 TRI. Nifty 50 TRI has given about 17% CAGR over the last 20 years. Corporate earnings, which is the middle data point, has grown at about 11.5%. The Indian GDP has grown by about 12.7%. So there are different parameters. The GDP has grown by only 12.7. Corporate earnings has grown by 11.5. Nifty 50 has grown by 17%. Now we may add inflation and we can get some maths into it, but be as it may, these are three different return numbers. At the same time, you look at the volatility part of it. Now, this is important because this is important to understand the topic that we are at. GDP with 12.7% growth has shown a volatility of 4.7%. Corporate earnings at 11.5% has shown a 14% volatility, whereas a Nifty 50 with a 17% growth has shown a volatility of 31.7%. The point that I'm trying to make here is that investors may find participation in wealth creation journey of equity difficult because of this volatility of 31. Now, there is a huge 31.7% is huge as compared to 14% and 4.7%, right? It's huge. It's almost double that of corporate earnings. It is almost 7 times that of GDP. So, but at the same time, the returns have been significantly higher. So we need to understand that higher returns would imply higher volatility. However, for the investors, this is something which becomes very, very difficult for them to sort of digest when they are part of the investment journey, when they are part of this journey of generating wealth. So this is something that we need to keep in mind, and I'll tell you where do we sort of implement this during our interactions with our clients. Again, the last 45-year period, you see that the Sensex, the BSE Sensex from April 79 to March 24, the percentage of days making an all-time high is about 7% only. Okay. And the percentage of days at a 52-week low is 9%. What it means is the stock market is underwater, is not making all-time highs 93% of the time, right? So what does it imply? Are we looking at all-time highs every time? In this 45-year period, if 93% of the time the markets have not hit all-time highs, still given you 15.25 CAGR, we need to put both of them together. The lesser we look at the markets on a regular basis, it is better for our health, it is better for our investment decision and our investment confidence. So we have volatility. Sorry. So volatility is there, but volatility is important because volatility will help us generate returns. Volatility is important because volatility creates that return for us. So we should ensure volatility is not a bane. It's actually it's supporting growth. Now you look at the returns. You look at investment returns and investor returns. Again, the first slide that I showed, and you look at a 10-year horizon. Now in a 10-year horizon, the investment returns have been about 12.3%, whereas the investor return, and this is a Morningstar data, which is Mind the Gap study, which was concluded in November 2022. It sort of considered asset weighted returns across the Indian mutual fund categories. So the returns were about 12.33% for the investment product. However, the investors just got about 9.53%. And this is a 2.80% less. Now, in percentage term, you may see that it might look a little less. But if you look at an investment of about 1 crore, and you look at the same 10-year horizon on the right side of the slide, you are looking at a gap of about 71 lakhs. The investment asset has given about 3.20 crores in 10 years, whereas about 2.5 crores in 10 years for the investor, making it a gap of almost 71 lakhs. So in absolute terms, it is compromising the investor's experience. It is compromising, the return that an investor is getting. And this volatility is the source of compromised investor behavior. So what I discussed in my previous slides is the fact that returns will be generated, but it will come with volatility. It has to come with volatility. And that is what we need to keep our investors well informed of, because of which they need to understand that they should not look at volatility to determine their investment behavior. Volatility is part of the game. They should never look at volatility as determinant to their investor behavior. That is something that we need to keep on reminding our customers and ensure that they sort of tide over this volatility over their investor behavior. So what is an investment? An investment behavior is like that of a marathoner rather than of a sprinter. You need to look at the very long term. Both are typically different sort of games. In a sprinter, you have a different competition time period. If you look at the pace, it is very different. The distance that you run is very different. The focus that you need to have, the training focus, is very different from that of a marathoner, whereas the training methods are also different. So the investment or an investor behavior is closer to a marathoner rather than a sprinter. And therefore, we need to educate our customers and tell them that, yes, we need to stay course, for the long term, ensure that our behavior is maintained for the long term, because we are looking at long term wealth creation. Wealth creation can never happen in the short term. It has to take a while, and volatilities over a period of time will always be there. I'll give another example. Now, if you look at a very successful captain of the IPL team, and coincidentally, the team is from the south, which is the Chennai franchisee. And if you look at the captain of that IPL franchisee, who is also a very successful captain of the Indian, cricket team, and if you look at the statistics, you will find that as a CSK captain, of the 226 matches, the captain won 133 matches and lost 91 of them. He failed to win 7 out of the 12 attempts in the IPL finals. However, can any person deny that this captain is one of the most successful captains of the Indian cricket team? No. Right? He is etched in the history of the Indian cricket team. He's etched in the history books of the IPL franchisee, and he is considered amongst the greatest captain that Indian cricket team has. But does the statistics say that he achieved 100% success in whatever he did? He just achieved success 60% of the time. Believe me, if you are hitting the ball 60% of your time, you are going to be extremely successful over a long period of time. Again, it's a period of time that is important. So we need to ensure we need not get all our decisions correct, right? But we need to ensure that we are looking at doing things correctly at least 60% of the time over a longer period of time. Another data point. Now, if you look at again the last 45 years, which is April 79 to March 74, the percentage of positive days where the average returns have been positive is just 53%. Rest 47%. So number of days is 10,446. Out of that, only 53% of the days the returns have been positive. Average positive return is 1.07%. But the CAGR works out to 15.24 over a 45-year period. So it's a phenomenal data point that we need to keep in mind when we are engaging with customers to counter the volatilities of the capital markets. In fact, negative days, you look at it, the negative returns is 1.05%, right? So the difference is what? 53% positive returns, 53% of the days is positive returns, 47% of the days is negative returns. Average positive returns in these 53% of the days is 1.07%. Average negative return in these 47% of the days is 1.05%. So net is only 0.02%, right? But the CAGR, look at the CAGR that it is generated. Again, it's the time duration and it is staying put in the market, which is important. So what is the magic wand of trying to tackle volatility? I think this is something which is extremely proven now, that systematic investment plan, SIP, is what is the magic wand to ensure that we tide over volatility. Volatility is a feature, it can be worked in our favor when we look at SIPs for our investing clients. Now, if you look at the last 5-year SIP returns of the Nifty 50 over the last 15 years, the average 5-year SIP returns has been 12.47%, right? And you look at these markets, which is the 5-year return, the sort of the blue lines, which is the graph in the shaded area and the blue, and you will see a lot of volatility over the last, again, 15-year period, especially during March 20, when COVID hit. So instances of more than 8% returns in the last 15-year period is 87%. 5-year SIP returns at the market trough, which was March 20, was at minus 2.8. However, immediately after 1 year, it was at about 15.12% CAGR, which surpassed the 15-year average of the. So you look at this. Now, if you look at 1 year at 2020, 5-year SIP average returns at 2020 was at minus 2.8. 1 year from there, the 5-year went up to 15.12, right? So it's a significant step up. So SIPs definitely are the way for our investors to tide over the volatilities that the markets throw at us. And we need to look at least a 5-year return to ensure that the SIP is working in terms of averaging out the cost of purchase. So volatility is a boon. We need to take this boon along with the product feature, which is called an SIP, which will help us tide over the volatilities of the capital market. Another feature that customers keep on looking at is point-to-point returns with respect to rolling returns. So if you look at typically customers today in the market, mid cap, small cap, phenomenal returns that we've got. I think it's about 2-3 months now that probably that would have died down, but let's say 3 months back, every customer was looking at pushing business into mid cap, small cap. There was a huge demand in these two categories simply because 1 year return 70%, 1 year return 100%, 1 year return 120%. And if you go to a customer and tell them, sir, we have come here to give you a product and 5-year investment horizon, and we are looking at 15%, 20%, he will look at you and as though you've come from some other planet. Right? What the hell are you talking about? The markets have given 100% returns and you're talking about 15% returns. Are you joking with me? So what we need to understand is, and this is something which I keep on repeating to all my distributor friends, all distributor fraternity, when they are onboarding clients, they are looking at the clients for a very long term, possibly into perpetuity, possibility into second generations, both for the client as well as themselves. In my experience, when I go and meet distributors, I have seen so many distributors getting into second generation. I have seen so many customers getting into second and third generations. Right? So when you're looking at that kind of time period, when you're looking at that kind of horizon, and you're looking at investment, which is again a very long-term view, you are matching the investment, the objective, as well as your behavior is matching with it. What we need to align also with this too is the customer's behavior. So we have our behavior when we are wanting to get on board a client for a very long time. We have the product, which is again a very long-term product. I mean, very long-term means investment is a long-term, long-term horizon. We need to onboard the client also for this long-term journey with us. So it is always important to understand that, yes, please look at rolling returns for 2 reasons. First is it gives a much more accurate picture for the customers to do a reality check. It is important to do reality checks all the time. Small cap, mid cap is not going to give you 80, 90, 100% returns for perpetuity. You look at the graphs on the right side of the table. You look at the rolling returns for the last 15 years, from March 09 to March 24. The blue bar is of 1 year rolling, the orange bar, the yellow bar is a 5-year rolling. And the average returns in a large cap for 1 year for the last 15 years in a large cap is about 20%. For a 5-year, it is about 12.6%. Similarly, for a mid cap, it is about 33%. For a 5-year, it is about 16.5%. Similarly, for a small cap, it is 34%, and a 5-year horizon is 13.4%. However, please also have a look at the standard deviations mentioned below, which is for a 1 year rolling average of the small cap at 34.4%, you are getting a 53.5% volatility, which is huge. Now, again, this is a 1 year rolling, so that's okay. But again, look at the volatility. And if you're looking at 13.4% over a 5-year rolling for a small cap, you look at the volatility which has shrunk to 7%. So customers need to be given this perspective of risk versus return. In the financial services industry, the bottom line for costing a product or getting returns from a product is the risk associated with the product. Whether you go into loans, whether you go into investment products, the risk and returns, the risk determines the returns, the risk determines the cost of the product. It is very important to educate the customer. So if you look at the mid caps, the mid cap has given 16.5% 5-year rolling for the last 15 years with a standard deviation of 5.5. So is 16.5 with a standard deviation of 5.5 better, or is 13.4 with a standard deviation of 7 better? We can, all of us would know the answer. There is no rocket science in this. It's actually very simple. So we need to educate. If we understand what we are seeing in this slide, it is important that we communicate the same to our customers and ask them to please ensure that they look at rolling returns. Point-to-point return is hazardous to health, hazardous to investment behavior. Because when you look at point-to-point returns, you will put your money in a particular asset category where you may get good returns over a short period of time, but when you're looking at the long-term horizon, you may lose out. Your investor behavior becomes contrary to what it should be. So, if you look at this, it's not about predicting the future, it's about understanding the probabilities involved. So it's not, successes is not always what you see. Below the ground, what is it? You may see a lot of greenery above the ground, but as was the case with Titanic, the iceberg which sank the Titanic was about 5 times bigger what you could see up above the water. So what is below, what is the underlying features of that investment product is what we need to keep in mind, is what we need to keep our customers aware of. Some of the biases that are there, there are certain things, the Sensex and the Gilt, they go against each other. Customers have these inputs from various sources. It is very risky to put your bet into a particular, parameter, a single parameter. For example, the gilts move opposite to the direction, opposite to the Sensex. So you had a period in 2003, 2004, when the 10-year gilt went up by 236 basis points, the Sensex also went up by 21%. Again, in 2008-9, the 10-year gilt fell by about 253 basis points. The Sensex also fell by about 51%. It crashed by 51%. So it is very, very important to understand that relying on a single variable and trying to correlate it to the markets can be very, very injurious, can be detrimental to, taking the right investment decision. This is a very, very interesting slide, and I love this slide because it shows exactly what customer behavior should not be. Okay. And this is what I keep repeating to my distribution fraternity. Please carry at least this slide and keep on, when you engage with your clients, is a very important slide to show them. So this is data point from 2008 to 2024. Okay. So that's about 16 years. And, what we have tried to figure out or found out is market P's less than 20, what are the periods, and market P more than 20, what are the periods. So P is not a very, very accurate measure of, valuations, but it's a fairly good representation of whether the markets are expensive or whether the markets are cheaper. Okay. So we all know that a P of less than 20 means that the markets are relatively cheaper. P of more than 20 is generally means the markets are relatively more expensive, generally. Okay. And it is proven by this, it is proven by the 1 year, 3 year, 2 year, 3 year forward returns of the Nifty 50 TRI. So when the market P was less than 20, the next 1 year, 2 year, and 3 year gave 28.27, 20.07, and 15.62% CAGRs. market P was more than 20, the forward returns came down to 7.3, 9.3, and 10.7, right? Which clearly shows when the valuation levels are lower, the return probability is much higher. And when the valuations are higher, the return probability is much lower, which means that when the valuation levels are lower, we need to ensure that more and more clients come into the market. And when the market P's are higher, we need to be cautious and we need to try and see how best we can manage our assets, our investments in a way that they do not erode. Okay. However, what has happened? The data shows when the market P was less than 20 in these 15, 16 years, what is the total inflow into the equity capital markets? The total inflow was 15,900 crores, which is about 16,000 crores. And take a guess what it was when the market P was more than 20. It was about 10 lakhs 70,000 crores. Now we really wonder, this is the investor behavior. This is data point to prove investor behavior is totally opposite of what it should be. And this is what, as advisors, as distributors, this is something that we need to ensure we communicate to our clients that, see, this is what investor behavior is, and this is what we need to guard against. However, I would like to qualify this statement because of my experience in this industry for the last 20, 25 years, that now, over the last 5-7 years, probably we are all seeing, and I'm sure Kapil and his team will agree with me, that when the markets are falling, probably customers are now saying, will it fall a little more? Shall I wait a little more to pump in more money?
Sorry, Siddharth, to cut. They just don't ask that question. They are confirmed belief and they make us believe that it is going to fall more.
Yes, yes. So it's actually a very healthy movement which is happening, where the customers are actually now, over the last 7 years, are saying, okay, will it fall a little more? Shall I wait a little more? So that's a healthy thing. But this is something, and this has come because all of the distribution fraternity has also educated them, as well as a lot of input that the customers have also generated for themselves. So this is a very important slide which sort of gives the proof of what investor behavior should not be. So what are the factors? Some of the factors I've enumerated. I'm sure there are many more, but what is it that we need to tell the investors, tell our clients about? Market volatility. Please do not worry about market volatility. It's a feature. It's not a bane. We need to take advantage of market volatility, and SIP is the way to sort of tide over market volatility. Point to point versus rolling. I've spent some time on point to point versus rolling returns. Point to point returns are hazardous to health. Please ensure give them the rolling returns along with the standard deviations, because standard deviations are a measure of the risk for that return, and it is important to educate our customers what are the risks associated with the returns. And when you take risk adjusted returns, always you will see that there will be, you'll be surprised that probably this is a better investment option as compared to what I was generally thinking. Valuations, I gave this classic example of when market P is more than 20, market P is less than 20, what we should be doing. I don't think anybody in this group will deny that we should be putting in more money when the market P is less than 20. But what the data proves is what the customers are doing totally opposite. And trying to predict the market. People have these myths that, the gilt, the G-Secs and the markets move opposite to each other. These things are hazardous to health. So we need to keep our customers educated for them to take the right investor behavior decisions. Let's look at another aspect of the wealth creation journey, which is the asset allocation part. Now, as we have volatility, and why I included this small section in this particular presentation is because I've spent a lot of time on trying to talk about volatility. And one of the ways of beating volatility, what we discussed was SIP. But again, we have what is called the fundamental principle of investing, which is asset allocation. And because we are in the mutual fund industry, we have the equity, debt, which are the primary two asset classes. We also have some commodities like gold, silver, XYZ. We do not still have the real estate. There are some funds which do have some kind of a exposure, but predominantly it is these three asset classes. So asset allocation is very, very crucial to take advantage of, to try, one, obviously to diversify your risks, and second is also to try and take advantage of the various opportunities different asset classes present themselves in different periods of time. So if we sort of restrict ourselves to debt and equity, because that's what predominantly mutual funds look at, we have so if you look at the left hand side of the chart, the last 20-year period returns and the standard deviation, which is, as I mentioned, the measure of the risk, is given. The blue bar is the returns, the yellow bar is the measure of the standard deviation. While equity has given 15% returns over the last 20 years, it has also given a volatility of 21.6%. On the other hand, while debt has given about 6.9% returns, it has given a standard deviation of much, much less, which is about 3.1%. So higher returns of equity asset classes are coupled with higher volatility, and vice versa for the fixed income category. So lower returns, lower volatility, higher returns, higher volatility. Couple this with the correlation between the asset classes. There is a very low negative correlation between debt and equity in terms of their returns, and obviously the standard deviations are there. This low negative correlation between debt and equity makes it an ideal combination to have as an asset class, as a product mixed together, to sort of diversify the portfolio risk, and try and look at returns which are better in terms of risk adjusted returns, right? So risk adjusted returns is the catchword here, and that is what an asset class which is a mix of equity and fixed income tries to give. Now just look at this data point. Again, this is a period for the last 20 years, and as I mentioned earlier, a pure equity, 100% equity portfolio, which is the extreme left side of the chart, which is given 15% returns with a 21.6% standard deviation. Now you change this asset allocation into 50% equity and 50% fixed income, which is in between, giving you 11.5% return. The blue bar is the return. But just look at the yellow bar. The standard deviation has halved itself to 10.9%. You change the equity allocation a little more from 30% equity to and 70% fixed income. The returns come down again from 11.5 to about 9.8. But again, you look at, because of the increased exposure to fixed income, your standard deviation or the risk associated with this comes down to 6.9%. So it is important to understand that asset allocation gives a better risk adjusted returns for our clients, and it is important to give this perspective to the client, because sometimes the clients rush after. So I will shudder to even give the example, but because we are in this session, if you look at the asset class which was a hot topic just about a year back, which is the bitcoins. Now, can anybody calculate the standard deviation on bitcoins? I think none of us will be able to calculate the standard deviation in bitcoins. You may have had the returns which had come for a period of time, but so this is an extreme example I'm giving, but I'm just trying to highlight asset classes, risk assessment, both are important. And combining asset classes with standardized risk assessment features gives the best balance for clients. Some of the fatal errors that I think all our clients do, and we need to guide them not to do: putting all the money in a single investment. Always ensure that they diversify across asset classes. It is important. As I said, a lot of asset classes gives options, returns in different periods of time. We have seen enough examples of it. We have seen examples of gold. We have seen examples of real estate. We have seen examples of equity. There was a period of time when we were in the mutual fund industry, when we are in the mutual fund industry still, but a period of 5 years when all of us in the mutual fund industry was saying, boss, why are we in this industry? We were questioning ourselves. We might as well, have bought, fixed deposits and just been, because equities were not just giving returns for the 5 years. It was just flat, right? So, but you look at how equities have pulled up. So different asset classes will give returns in different periods of time. Please ensure all your clients diversify their investments in different asset classes. Never invest with borrowed money. Right now the biggest scare that SEBI, that the finance minister, that I think a lot of the financial papers are coming up is in the FNO segment, right? And the fact is that 93%, the SEBI report says 93% of retail players, they're not investors, I'll not use the word investors, retail players in the FNO segment have lost money. 93%. It is only the well-entrenched, big, data-driven, fund managers, fund houses, the FIIs, the DIIs who make money. So, and let me also, put my, where my thought is. 93% of the retail investors, out of these 93%, I'm sure about 80% will be playing in the FNO segment with borrowed money. So it's a very, very vicious cycle. Please ensure. So these are all points that we need to keep on engaging with our clients on, to build their trust, to build their confidence, build their wealth, build our business. Please ensure these basics are communicated to the client. You're reaching out to a very big audience. This is an industry which will definitely keep growing. There'll be a lot of things which will keep on coming. A lot of noise will keep on happening. A lot of inputs will keep on coming from various social media platforms. But what we need to keep in mind is stay true to course to the investment process, because we are in it for the long term. And these are short-term fads which will keep coming and going. So, Jeff Bezos, Amazon, one of the things that he keeps asking his strategic team is not what will change. So change is the only constant is the biggest cliche which is there, right? Definitely change is the only constant. But what is important to know and realize, there are some things which will never change. Some things which will never change. So customers for Mr. Bezos, they will always want lower prices and quicker delivery. So he has his team, Amazon, works on the motto, lower prices, quicker delivery. That's the motto on which they work, right? This will never change. This is a universal truth which will never happen. Again, in the compounding interest formula, I think class 7 or 8, we were taught this formula in maths, which is amount is equal to principal into 1 plus r over 100 raised to power t, right? Here, at that point in time, the rate of interest we used to keep changing. Rate of interest itna ho gaya, so we'll have so much of returns in the amount. But over a period of time, as we get a little bit of gray hair or gray beard or gray moosh or whatever it is, so over a period of time, we have realized that along with the return rate, the time spent in the market, because this is raised to the power, right? It is raised to the, when you're looking at raised to the power, it is multiplying things in a very, very rapid manner. It's the classic case of, if you look at Provident Fund or the PPF. Now, after first 7 years of investing, once a corpus is reached, the power of compounding starts kicking in, and that's when you see real returns being made. Time spent in the market is more important than the returns that you're generating from the market. It is important for us to keep our customers clued on to this. We are there for the long term. We are onboarding clients for the long term. Our product is for the long term. We need to get our customers tuned for the long term. But there are some noises which keep on happening in between, which sort of diverts the customer's attention. And that is what we need to get them back on for the long term. So some of the points that we discussed during the course of this session: investing is like a marathon, it's not a sprint. We need to make our customer behave like marathoners. Markets are more volatile than the economy and earnings, but volatility is a feature, it's not a bug. You do not have to win all the times. Even if you win 60% of the times, you are home. Always consider rolling returns over point to point returns, because point to point returns will blur your judgment. Stock markets will surprise you. Set correlations will change. So don't try to predict the markets. Don't try and outguess the markets. Just stick to basics. Valuations, again, always look at valuations as a margin of safety. Never look at valuations as, these are the, and the classic case of falling into the valuation trap. This market is growing, so just jump into it, is something that we need to be aware of. Asset allocation is a friend, it's not an enemy. Diversification is a key to survival. Leveraging is very, very dangerous to our health. What doesn't change? What doesn't change is we need to have higher returns with lesser risks. In the compound interest formula, the time spent in the market is much, much more important than the rate of return. So that's all from my side. Thank you very much for being part of this session, and I am open for questions.
Thank you, Siddharth. Siddharth, can you just disable the share screen?
Yes.
Okay. Thank you, Siddharth, for the lovely presentation. But one thing which we still have to understand, that no matter how many sessions we do on this, people will still continue investing above 20 PE. So
Yes.
I don't know how successful we'll be in that, but we will keep on trying.
Yes.
Okay.
Yes. Of course.
Regarding questions, Mr. Ronald is asking, many mutual fund distributors notice that giving too much information offers increases investors' fear about staying invested in equity. Okay, how can we effectively present only the essential points to reassure clients that volatility is a natural part of investment journey? What would be those pointers according to you?
So you cannot stop information. So the customer will get information from somewhere or the other. We have WhatsApp University, we have Google University. All these universities are open, freely accessible to everyone. Everyone has the information. What we need to stay true to is our conviction about basics in the market. Actually, and I actually would like to apologize here, but investment is actually a very, very boring process. It's us who try to make it much more exciting, and in the process, quite a lot of times we fall flat on our face. Start as early, be as regular, be as long term. I think these are the three critical mantras of investing. All the other aspects about volatility, about valuations, they will keep on coming. But yes, we need to educate our customers, and this is where the value add the customers will see from us, from all of you distributors, all of you friends. That is the value add that we are trying to that you will make with your customers. And these sessions, I think, very well done by the Prudent team. These sessions will add value to you to add value to your customers. We have to be very, very clear in our communications with these data points. I think these data points clearly highlight that even though volatility has been there over these last 45 years, the markets have still given returns. So I think it's one of the thoughts that I can share is that probably have a deck on 2 3 different points, like volatility, like valuations, like different asset classes, like diversity, and ensure that whenever you engage with your clients, you are using some data points to present your case, and I'm sure those data points will definitely help.
Thank you. Mr. Haribabu is asking, we can show the illustration investment SIP mode in more volatile market than in a flat market. How much does the investor make in 5, 10, 15 years? So this will help. Will this highlight the volatility help? And will it help the investors?
Can you just repeat the question, Kapil? Yeah.
Not a question, it's a suggestion for what Ronald has
Yeah,
said.
yeah.
So what he's saying is that we can show a small illustration, like market, volatile market versus a flat market. How
Yeah.
much does the investor make in 5, 10, 15 years? So this will highlight the volatility. But is it possible to make such an illustration? A flat market and a volatile market?
So you can take periods of times when the markets were flat and when the markets were volatile and
5
make
years, 10 years
illustrations.
periods. I don't think so it was never ever there flat and volatile.
Yeah, actually, there are never flat periods in the long period of time. But yeah, I mean, uh, illustration of SIPs. See, I honestly have not come across any illustration of SIP where there have been, lesser returns or flat returns. All illustrations of SIPs, and that's the beauty of the time in the market. If you look at 5 year rolling period across asset classes, across equity products, returns have definitely been made. It may vary from a, let's say a low 12% to a high 20%, but then returns have always been made. But yes, illustrations always help, give a very good perspective to our clients as to what they can expect.
Mr. Ronald is asking a question. Is booking profits from mid and small cap funds and reinvesting through STP in large cap, multi cap, or business cycle funds a smart move during market corrections? Considering tax implications and profits, what does this approach offer advantage?
So
Does there,
what is the name of the gentleman who asked?
Mr. Ronald?
Mr. Ronald, in my presentation, I have made one point about do not try to predict the markets. Do not try to predict. So, what large cap, mid cap, small cap will do? What you need to do is basis the client's objective. What was the investment made for? Is it an objective? Was the objective, let's say, children study? Was the objective of foreign travel? Or let's say, okay, minimum 5 years, I have made 20% or 18% or 16% returns. Now I need to rebalance. So, what is the investment objective? Do not base your decision on market, trying to predict the market. So that's part of the presentation because that will lead to a suboptimal return in the long term. Look at the objective of the client.
I think Ronald, what sir says many is very effective because one of our partners, Mr. Haribabu, I was sitting with him and he was showing me all his clients' goal sheets. Okay, he made particular goals for all these clients, and he expressed the beauty when some client achieved a goal. Maybe that he has set 5 goals for that client, and after achieving one goal, when he called them and made them and wished him, said, "You have achieved now this goal." The happiness which is revealed, when Hari Babu said it to me, was not brilliant. Matlab, the way they
Absolutely.
have said they have presented it, I think those are the things which all partners should keep on doing. In fact, I thought I'll request Mr. Hari one day to take a presentation. How do you make these goal sheets? How to present it to clients? Now, that's the beauty. Since he's a very educated guy, he can present it to the client very beautifully, and the client listens. But 90% of the time, client does not have this patience to make this goal sheet. So that's the thing. Okay.
And just to add to what Kapil is saying, I think that takes the relationship to a different level. You are you are you are taking the client away from these short-term noises which are happening in the market to the real objective of what the investment should be for. So that is important.
Sure. Mr. Sharad Poddar is asking, how can an investor effectively balance the potential for long-term growth with short-term risk associated with market volatility? And what strategies or asset allocation approaches can be employed to mitigate losses during periods of significant market fluctuations? This is again about timing market, I don't know.
Yeah, so it's again about trying to time the market. You know, uh, it's again three simple fundamentals for me: start as early, be as regular, be as long term. Look at the investment objective. If you want to time the market, nobody has. My fund managers say that if I were able to time the market, then I would not be a fund manager, right? So let's not look at. So for each of your client, you need to build up the client's risk assessment structure. Okay, you need to ensure that this is the client's asset allocation mix. You need to discuss with your client basis the risk assessment what should be the risk asset allocation mix, and from time to time try and see whether the asset allocation is falling in. Say for example, you have decided that okay, for a particular client you're looking at 25% mid and small cap, but as of end of last year, because of the valuations of mid and small cap, it has gone up to 35%. Now, the objective is not to exit from mid and small cap, because data shows that in the long term, I showed this data, 5-year rolling, the best risk adjusted returns is mid cap, right? The best risk adjusted returns is coming from the mid cap category. But the objective is, if you have decided that 25% is what the risk assessment for a particular client gets, gives you, is for the client, and because of the valuations, it has gone up to 35%, that 10% needs to be rebalanced. And that is what is the scientific method of investing, because that helps in the long term to ensure that you cut out the the market ups and downs and the volatilities and all those challenges that are there in the market. You set your goal for the client with respect to risk, with respect to the asset allocation, with respect to the goal, and then you continue stay par for course.
Thank you, Siddharth. Mr. Sudhakar is asking, nowadays many investors are investing in stocks directly. Seeing influencer tips, God knows who all are on YouTube, what are they suggest, what are fund stocks they want to offload, and they suggest, I don't know. How to convince them to actually come into mutual funds?
Right, that's an interesting one actually.
Before this
That's
answer,
an interesting one.
before Siddharth will give this answer, I was in Kochi last week. So what I found in Kochi was every third or fourth shop was a lottery center.
Yeah.
Every third and fourth shop. I
Yeah,
was
yeah.
thinking, and I was speaking to my colleague Sujit over there. I'm like, "Yaar, why not we put a stall here and say that every month if you are spending 500 to 1000 rupees on buying a lottery ticket, I don't know how many people have won the lottery, but you surely will become a crorepati in another 15, 20 years."
Correct. Correct. That's what. So, yeah, so, it's an asset class which is there. Stocks are an asset class which are there. Now, how do you convince? Now it's all about, so if you look at an ex-customer, you can't stop customers from, as I said, WhatsApp University, Google University is all prevalent everywhere. And they give all sort of information for the benefit of the customer. But what is important is to understand and communicate to clients that it is not about short term investing. Wealth creation will never happen at the short term. You have to look at it from the long term. You need to look at diversifying your risks. You need to look at uh, creating wealth step by step. If you think that you buy a stock or two stocks or five stocks or 10 stocks in a very short period of time, and you expect it to buy through some tips that you're getting or whatever inputs you are getting, I think there are many examples available in the market where people have just burnt themselves by taking those tips. And it's like the FNO story, right? It's like the FNO story. 93% of the retail customers in FNO are losing money. Now, I know it's a tough task. There was a time, I remember, I don't know how many of the distributors are of that vintage, but you had, the teak forest plantations, right? You had, MLM marketing, so all those kind of stuff. But end of the day, a normal salaried retail customer or a retail investor, the risks involved are simply too much. So again, the risk adjusted returns is something that we need to keep on telling our customers. You may invest in a stock, you may invest in a portfolio of stocks, but the risks that you are taking with respect to a 5 or 6 or 10 stock portfolio versus a 50, 70, 80 stock portfolio managed by a professional fund manager of a reputed fund house, which is managing 1 lakh, 2 lakh, 3 lakh, 6 lakh crores of assets under management, is a totally different ballgame. So that is something that we need to keep on, and it's not for anyone's sake that we are talking that SIP should be the name of the game. Please mention SIP, please do SIPs. And people are the Association of Mutual Funds, of the T-shirt of which our dear friend Mr. Kapil is wearing, mutual fund sahi hai, is spending so much amount of money for customer education, is to make them realize that please ensure that you diversify your risks. So that is something that will keep on coming with a lot of activities. And that is why mutual fund companies, even ours, do a lot of IAPs for customer education, for telling them, that what is the right way. You should be aware. Let the customer invest in stocks, no problem. It's a legal asset class. They can invest in it. But are they aware of the risks of that asset class is what we need to make them aware of. For that, you want to do IAPs, please reach out to Kapil and his team. We'll be more than happy to help.
Sudhakar, I'll put what Siddhartha has put in a very layman language whenever, not from today, around 15, 20, 25 years back, when we started selling mutual funds. A lot of people come to me and ask me why I should invest in stock markets, why I should not invest in stock market. We get so many tips, we can subscribe for the tips and they get good returns. Every fund house also offers. So I tell them in a very layman language, so there are three things which are required to invest in stock market. One is knowledge, second is time, and third is money, and lot of money. Remember, okay? Knowledge means you should be knowing what is happening with crude. You should be knowing with what is happening in geopolitics. You should be knowing what is US market opened, how has the Japanese market opened. All the sort of knowledge which CNBC has filtered, you should have it. Second thing is, you cannot be a very good economic professor teaching in school and having this knowledge and sitting in stocks. Understand, you have all the knowledge in time, but you don't have time. You are teaching in the college, okay, and suddenly when you enter the class and come out of the class, already the market is down by 2000 points and you lost all your money. So either knowledge or time if you don't have. And third most powerful is money, lots of money. For example, you have bought one stock which is down by 8-9% in one day, and you know that you are assured that this will again go up. If you do not have the money to leverage or average, so it's waste. So if you do not have any one of these three things, that is money, time, and knowledge, don't enter the stock market. Give your money to someone who has all these three. That person is called as the fund manager. He has a AMC backup, your funds backup, knowledge in terms of he has got the entire research team, time, it is his only job. He has no other jobs with him. Okay. So give the money to him. Whatever profit is, it's yours. Whatever loss, it's yours with a very, very nominal fee. So this is the easiest way how I convince a person to invest in mutual fund instead of a stock market.
And also, and now the fund managers have to put their money in their funds as well.
Okay.
So SEBI has made a guideline that the fund managers have to invest in their funds.
It's only in their fund, or they can invest in other funds also?
They have to.
Okay. All their funds or some part?
Oh, not all. Then they will be out in there.
Okay. Mr. Mallikarjun asking, is multi-asset a safe bet at this point of time?
So asset allocator funds like Balance Advantage, multi-asset are all-weather funds. This is one fund category which you can safely do lump sum at any point in time because they are tuned to sort of rebalance themselves basis the asset classes they are in. For example, Balance Advantage fund in equity and debt, multi-asset in equity, debt, maybe gold, whatever. Depending on what the market conditions are. What is now happening in that category, I'll just give a little update, is that a lot of these auto asset allocator funds are now being driven by, various parameters, quant driven asset allocation strategies, which is data driven. For example, in UTI, our multi asset allocation fund, the equity allocation is determined by four factors, which is P, PB, debt, yield gap, and the dividend yield. These four factors determine what is the equity allocation. Now, currently, the multi-asset fund that we have is the model states that the equity allocation should be only 47%. However, the lot of other multi-asset funds would be at a much higher equity allocation. Why is it at 47%? Because the parameters, economic parameters, require it to be at 47%. So there's a lot of quant and AI generated, data driven asset allocator funds which are there. And coming back to the question, asset allocator funds are a safe, good bet at any point in time for lump sum. So you can please go ahead and with your eyes closed and give asset allocator funds to your clients.
One question. Name three your favorite UTI mutual fund names.
So as in this point in time, if you look at an uh, opportunity perspective, now this fund 6 months back would be at the bottom in terms of performance. So it's again, you have a performance pitch, you have an opportunity pitch. Performance pitch, all the small cap, mid cap, all of that will come. Opportunity, you have to use a microscope to try and find out where are the opportunities which are there. So this particular asset fund was 6 months back at the lowest in terms of performance across asset classes, across fund houses in the industry, right? We have stuck on to this fund for the last four years in spite of underperformance, because we have a very strong belief in the quality of the portfolio and in the philosophy that that fund represents, which is an out and out growth story, out and out growth portfolio, quality growth portfolio. So this is a UTI flexi cap fund, and we have last 6 months we have seen very strong sort of signals that it is going to, the growth story is going to come into the Indian market. 3 years back, this fund was adding to the returns of any investor's portfolio. It has not done well last 3 years, but we have a very strong conviction. And I'll give you one more example. We launched two funds a month back. One is called, the asset. One is called the private bank uh, index fund, and the second was the quality index fund. Both the quality index fund and the private bank index funds have strong representation in the UTI FlexiCap fund. So that is one fund that we would be looking out for. The second, of course, is the multi-asset allocation fund, which is a auto asset allocator fund. And I would say that we have some fantastic smart beta funds like the Momentum 30 Index Fund and the Low Volatility Fund. These are three categories where we are very we would be extremely strong in terms of our product quality, in terms of our performance. However, having said that, we have funds across all the segments in the market, and but these three, as of this point in time, I can put it on the table.
Thank you, Siddharth. Before we wind up, one last question. As one of the clients of Ronald, he has invested a big amount he has retired and invested in SWP. Okay. At a 6% annual withdrawal, he has put in the amount. So he's getting some money. Now, since the market has corrected a little bit, he is asking, should I stop the SWP for a certain amount time of 6 months or let it continue?
Is that SWP being used to put food on the table? If yes, then please do not stop. If it so, it's the customer's requirement. I think it's very important to understand what the customer's requirement is. So the SWP must be because of the customer might be wanting those funds for their monthly expenses. Now, if it is surplus, then definitely they can reduce it. You need not have a fixed amount as an SWP. Again, one more thing that I would like to, now that SWP thing has come up, and we are looking at long-term investments. If you have a customer with whom you have started an SIP for whatever goal, first thing is that please ask the customer to start one more SIP only for retirement. So that customer will not look at that SIP at least for the next 15, 20, 30 years, because it is for retirement. That expectation has been built into the customer. This is for retirement first. Second, when this corpus has grown, this retirement corpus has grown, please do not take it out and put it in any debt scheme. Continue to put it in an equity scheme, in the same equity scheme. Even if you do an SWP, you will see after 15 years that corpus will keep on growing. Your AUM, your clients AUM will keep on growing even after an SWP from a equity fund. So please continue with that. And SWP, coming to the earlier question, is a determinant of what the customer's requirement is, because post-retirement, different requirements come in. If it is a surplus, please reduce the SWP. If it is not a surplus, there's nothing that you can do about it.
Thank you, Siddharth. I
My
think
pleasure.
we are done with the questions. The best part is almost 90% of the partners who have started the session are still intact. So this was a very useful session, and really you put some real thoughts to the day with the presentation. So मतलब practically एक चीज समझ में आ रहा है कि 90% of the investors don't actually make the money which the return chart has shown.
Not at all. And it is their behavior which determines it. And that's what we need to be working on.
Thank you, Siddharth, for lovely presentation. Thank you for your
Thank
time.
you.
Thank you all partners for attending this session. Siddharth, do you have any good SIP presentation? Because a lot of questions are there. Said, do you have any good SIP presentation? Can you share with us?
Yeah. Let me pull out an SIP presentation and I'll share it with you. Then you can share with the partners.
Thank you, Siddharth.
Thank you. My pleasure. Thank you, everyone. And happy Diwali to everyone, each one
Thank
of
you.
you and your families. Thank you.
Happy Diwali to you also. Thank you, everyone. Bye.
Bye bye.